The question is the most important question for Hunt 2.0 signals, which means this questions, there is a question that if you ask, it will eliminate 95% of the bad signals. So you'll be left with really high quality signals. But before that, I want to explain what is the market cycle. You see, the market moves in a specific way. There are only two ways the market can move. So if you were to divide the market into its different phases, as we know, it moves from a trend to a trading range to a trend. And again, like this over here, what you see is let me mark that. This is trading range because there are no higher highs and lower lows. So you can see this is a low and that's high. This one does not break it, and then this one does not break that. So we are in a trading range. It's going sideways. It's relatively easy to actually manage your trading by identifying these things. So there are two things in the market. One is trend and the other one is trading range. As a trader, you need to learn how to identify them. And the way to identify a trading range is that when you see a higher high and a low, you want to see this, and then you want to see if the market will break those levels. So when the price was coming down here, it did not break it and it went up. So you already have a trading range. You don't want to mess with those markets because money is made by change. You know, what is trading? You buy something and then you're looking for that positive change. So if you buy it for 10, you wanted to sell it for 12, 15. But if it goes down, then you lose. So when the market goes into a trading range, what are you doing? You've gone into a market where the market goes from 10 to 12 and it comes back to 8 and then goes back to 12, but you want your profit at 15. So that's the phase that you don't want. So what are you looking for? We want trends. Now the trends, there are two types of trading ranges. The trading range can either be very wide trading range, tall one, or it can be tight one. The tight ones are really nice because we can deal with them. We can actually take the breakouts of the tight ranges. That's one way of doing it. And so that's two ways. Like so the market, let me repeat myself, market stays in two phases: trading range and a trend. A trading range has two types, a wide one and a tight one. We want to avoid both of them. We don't want to trade in trading ranges, right? We want to find trends. Now, often when the market is in a breakout, in a trading range, it will break out. And when it breaks out, usually the momentum of the trend is very strong, and we call that the breakout phase. During the breakout phase, you will see a series of consecutive bulls or bears candles, which are called the trend candles. So look at these candles. They have very small wicks and big bodies, and they continue like that. I call them the breakout phase, which I learned from L. Brooks, right? Let's delete that bit. That's the breakout phase. So a trend market will have these two types of trends. I mean, there are, let's say you can say it 3 or 4 types, but they're just two. One is a breakout trend, which is a very fast trend. So if you were to go to a lower time frame on this, then it would turn into something like this. So let's look at this example here. Here you have a breakout. So you have strong bear candles, hardly any wicks, no bull candles in there. So if you were buying in this area, you're going to lose money, right? If you sell in this area, you're going to make money. Then those breakouts change into what is called the ascending or descending. So in a bear market, it's descending. In a bullish market, it's ascending channels. What happens is that it's still a downtrend, but the momentum of the trend is not as strong as it was before. So you will see those channels, and sometimes they would be converging, right? So what happens is, let's get rid of these lines. So what happens is that in this strong phase, when the momentum slows down, then let's suppose if you're going in a bull market, you have a strong move, and then you have 50% pullback, then you have another move, and then you have even smaller pullback, but then the next move is not as strong as this one, and then when it pulls back less as well, and then it doesn't break that level. So what's happening? It's kind of converging, and that will happen all the time. Usually what happens after this is that this is your phase 1 breakout phase, then you have ascending descending channel. This will then turn into most probably a sideways market. So we want to avoid that. And then what happens after the sideways market sometimes is that it will break out down and then we'll pull back. We want to trade here and it goes down. Or sometimes after going sideways, which we prefer, this is the setup one, it will break out, pull back and go further up. And that's what we like. So I hope you learned something. I hope I've set the stage for the most important question now. The question is, the answer is there an impulse move? So how do you find yourself a nice hunt signal? So for any hunt signal, before you see a signal, you want to see if there's an impulse move. And so in this example, you have a breakout here, then there's a pullback, there's weekend in between, so we didn't trade that. But look at this. This is Euro Yen, 3-candle impulse move. It breaks the previous lows. You have trend candles, bearish trend candles, which is followed by 3-candle pullback. And if you look at this pullback, these 3 candles have not even covered the range of this candle. It's not even broken that. So it's a nice, lovely little triangle. And at the end of it, you have a doji candle with a banana signal. What do you do here? Well, you go short here and stop loss up there. Where are my lines? Short here, stop loss up there, 2-hour target, done and dusted. That's how easy it is. So if you want to trade the Hunt 2.0 signal, it's a pullback mechanism, and we don't trade the signals. We don't trade the pullback mechanism. No, the concept is that you want to avoid trading ranges and you want to trade within trends. But then when you identify a trend, the question is, how do you get in? Do you just simply pull the trigger? For example, let's go back to the previous example. So if you look at, oh, not this one. Let me go to one more example. Right, suppose you were finding this as a trading range, right? All of this, and then it breaks out. What do? Do you go long here? If you do that, where is your stop loss? Your stop loss has to be all the way down here because that's where you'll be proven wrong. Well, that means your stop loss is too wide. Is there a better way of getting in? Well, there is. You wait for a breakout, and after the breakout, you want to wait for a pullback. And we have designed those indicators, the Hunt indicators, that give you those signals. So in this case, USD CAD, now I wouldn't have taken that, and I haven't taken this one. By the way, these pictures are pictures that I post in the forum for forecast and to see what phases the markets are. So on this USD CAD, what we see is that we have a breakout, and then the breakout has turned into an ascending channel. So it would either break out further, it would go into a trading range, or if it did go in, or it might even reverse, come back up, and then we probably can sell over there. So the answer is there an impulse move? An impulse move can be a breakout, right? It breaks out, then you wait for a pullback, you have a signal, you go long. So in this occasion, if it wasn't a weekend, I would have taken this signal and I would have woken up for a nice 2-hour target. Let's have a look at another chart. So this is the Swizzy. So Swizzy, there's a breakout phase. What do we see here? A nice, lovely pullback. We have an inside candle. I don't know why I'm not seeing a signal here, but there should be a signal. Probably not a signal because it's been filtered by an ATR value. But this is a good signal. You go long here and you let it run. This will probably be either a break even or a 2-hour, and then it breaks out again. So what's happening here in this case? The breakout has turned into a trading range. So nothing for us over there. Let's have a look at another example. Right, this is the Australian dollar. Really beautiful trades on this one. So if you look at this chart, I think this was on Thursday. So you have this ascending channel over here, which is going counter the trend. And what's it showing is that it's not going up. I call these like trading ranges. Like you can call them, this is something that's hybrid. Like this one you can call an uptrend, but at the same time you can call it a trading range because it's not really going up and it's not even going down either. It's kind of going sideways. It's a wedge, right? So whatever way it breaks out after this is going to determine what will be your trade. So what do we see here? I usually mark my breakout phases with this green box. So what is it? It's a breakout. So what is a breakout? It's an impulse move. That's the most important question for your hunt methodology or your pullback. If you want to trade trends and you want to make your entries using a pullback mechanism, because pullback is a great mechanism to get into trends. Pullbacks are not designed for trading ranges, because the idea isn't that we want to trade pullbacks. No, the idea is that we want to trade in trends. And then there's a question of how to get into a trend. One of the techniques of getting into a trend is the pullback entry mechanism. And we have a specific type of entry mechanism, which we call the Hunt 2.0. We have indicators for it, right? So what do we see here? We have the question has been answered here. Is there an impulse move? Yes, there is an impulse move. Is there a pullback? The second question. Yes, we do have a pullback. Look at this. None of these lows. Now I see there are a few wicks, which is not comfortable for me, but none of the wicks or none of the lows have been broken. And then it breaks this high, touches or goes into the area between the 10 and the 20 and gives me a banana signal. I would go short here, stop loss here, entry pending order here, stop loss up there. Very, very small risk. 2R will be hit very quickly. If I let it run, I could have even had 1:4 trade. So $100 risk, $400 profit. There we go. What's happening over here? We have a breakout phase. We don't have a signal over here. Even this was an impulse move, but we don't have a signal because the candles were in the no trade zone between these lines. I don't mind not taking because there are other markets that we could take. In fact, around here, I took Euro USD, which was setting up. So there was a signal here, but it was too late for me because weekend was coming. Otherwise, if it was a normal day, it's a really nice impulse move followed by a you can call it a one candle pullback followed by a confirmation candle. We have a BC signal over here. We have a banana and cherry. You'll go short here, stop loss up there, and your target would be hit overnight. You'll wake up to a nice lovely target. Or if you want to really, there are two ways of trading these signals. One is to have a 2R target. That's one way. And if you want to do trend trading, then in that case you can then follow the AIMS box or the 10 EMA or the 20 EMA, whichever you choose. Just stick to one. And then what's the difference between the two? Well, the 2R target is easy on the mind. You will have a higher win rate. You have to have a higher win rate, above 50% on this, and your targets will be 2R, so it's easier to manage. The other one, if you are into trend trading, which it would allow you to actually move your stop loss. So for example, if you take this trade, you'll be trailing the boxes. So for example, if around this time you have, actually there is a box up there that's forming, which would be formed actually around here. But suppose you moved your stop loss to break even in a situation, you'll be able to take another signal and add on to your position. So trend trading, the beauty of the trend trading is that you will have, well, it's a bit hard on the mind because you will have about 30, maybe even 25 to 35% of win rate, but your winners are going to be 3 times bigger than your losers, and you'll be able to add on to your trades. And basically adding on is what makes trend trading even more powerful. So you have to do that. Let's have a look at one more chart. So this is the New Zealand dollar. So on this day, Kiwi broke out. So what do you see? The breakout phase followed by a really nice pullback. What did I do? Well, I actually went short over here, and this was overnight. Like I said, if it wasn't weekend on the other charts, I would have taken it. There was a signal for me over here. I took it. It's not showing here because my settings have been changed. I've changed my settings to 180R. So there are settings in these indicators which you can change if you want to filter signals. So this one is not showing because it's more than 180R. But actually I did take it. I took this signal and I was stopped out by a pip, and then it went down. So that's your impulse move. That's your pullback. Unfortunately for me, and this would happen, sometimes you have a breakout, you have a pullback, and after the pullback, there are 3 options in there. Not options, but you know, this is what happens in the markets. It could have done another breakout phase, which is the ideal situation. That's what we want. You see a breakout or an impulse move, you wait for a pullback to the 10 EMA, you have a signal, you take a trade. The ideal case is that you want to see another breakout. That's what we want because it's easy. That did not happen. in some cases, what will happen is that there will be an impulse breakout, then you have a pullback, like in this case, and then it turns into a descending channel. This is also good. It's a bit hard to manage, but I don't have to manage anything. I have this ATM, right? I take a trade, stop loss is up there. It will move stop loss to break even when it hits 1 hour, and there will be a 2 hour target. I don't have to do anything. This is a little bit harder, but it can be done. In this case, what happens? Well, even this was not hard for me, because why? I was asleep all this time. And I think if it moved a little bit further down, my stop loss would have been moved to break even automatically by the script. But it didn't. It didn't do 1 hour. It came back, stopped me from -1, and then it continued. I could have gone back in. Why did not I trade this? I did not trade this. Why? I'll give you a moment. Yes. If you said because I identified a trading range, then you were right. Yes. If I see that the market is now in a trading range, then I will not take the pullback entries, which would mean that if the market is in a trading range, I will not take any of the Hunt 2.0 signals. If you want to trade this method and you understand this question, you will continue to keep 50 to 65% win rate, and your profit factor will remain above 1.5, and your average your average risk to reward ratio is going to stay 1:2 or 1:1.8. That's what I'm maintaining. So I hope you like this video. If you do, hit the like button and subscribe to the channel for more videos like this, and I hope to see you inside the AIMS forum. See you later.